Ever stared at a perfect trade setup, felt that surge of excitement, and then you hesitated? Or worse, you jumped in only to watch it crumble because you didn't stick to your plan. That gut-wrenching feeling? That, my friends, is the silent killer of trading accounts. But what if I told you there's a single unifying force that can transform you from a reactive gambler into a strategic master? A superpower that isn't about complex indicators or secret algorithms, but about something far more fundamental, yet profoundly elusive for most. Stay with me, because today we're unlocking that power. Welcome back to Trading Psychology. I'm T2, and if you're new here, you've just stumbled upon a sanctuary dedicated to mastering the mental game of trading. And trust me, when it comes to trading, the mental game isn't just part of it. It is the game. Today we're diving deep into the most underestimated yet absolutely essential trait of every consistently profitable trader: discipline.
It's a word thrown around a lot, isn't it? Be disciplined. Your parents said it, your teacher said it, and every trading guru on the internet probably screams it at you. But what does it actually mean in the context of trading? It's not just about willpower. It's not just about sticking to rules. It's a profound understanding of yourself, the market, and the delicate dance between the two. Think about the greatest athletes, the most accomplished musicians, the most brilliant scientists. What do they all have in common? It's not just raw talent. It's the relentless, often monotonous application of fundamental principles day in and day out. It's showing up when they don't feel like it. It's performing under pressure, not because they're fearless, but because their discipline has forged a path through the fear. The markets, in their chaotic beauty, are no different. They don't care about your hopes, your dreams, or your rent payment. They only respond to the collective actions of millions, driven by fear and greed. Your only defense, your only offensive weapon is the unwavering application of your strategy. From my perspective, discipline in trading is less about restricting yourself and more about freeing yourself. It's the freedom from emotional swings, from chasing phantom profits, from the crushing weight of regret after a bad decision. Early in my career, I was a victim of my own undisciplined impulses more times than I care to admit. I had a solid strategy, back-tested it, knew it worked, but the moment real money was on the line, suddenly every chart pattern looked different, every news headline sounded more urgent, and every impulse felt like a divine revelation. I remember one particular trade. It was a clear short setup on NQ market, based on my analysis. I put in my order, set my stop loss and take profit, everything by the book. But then the market started to consolidate, refusing to move in my favor. My mind, ever the trickster, started whispering, "What if it's going to reverse? What if you're wrong? Everyone else is buying this stock." I panicked, moved my stop loss further away, giving it more room to breathe. Of course, it hit my original stop, then bounced and hit my new, wider stop, effectively doubling my loss on a single trade where my initial analysis was actually correct. The only thing wrong was me. That's when I truly understood. My worst enemy wasn't the market. It was my own undisciplined mind. Let's trace the typical journey of a new trader. You start with excitement, maybe a small initial win. This is the honeymoon phase. You think you've cracked the code. Then reality hits, a string of losses. Suddenly, your carefully constructed trading plan feels inadequate. You spend hours, days, weeks researching indicators, strategies, price action patterns. You build a robust plan. I will only trade X pair when Y indicator crosses Z and the MACD confirms. You're proud of it. The market opens, X pair is trending, but Y indicator hasn't quite crossed Z yet, but it looks like it's going to, and everyone on Twitter is talking about it. You abandon your rule and jump in prematurely, only for the cross to never materialize and the price reverses, taking your capital with you. Lack of discipline to wait for confirmation. You take a small planned loss. It stings, but it's part of the game. That sting turns into anger. You feel the need to get back at the market. You instantly open another trade, perhaps larger than usual, on a completely different asset without any proper analysis, driven purely by emotion. This inevitably leads to a larger loss, digging you deeper into a hole. Lack of discipline to accept the loss and walk away. You've entered a trade, set your stop loss, and take profit targets according to your risk management. The undisciplined pitfall. The trade moves in your favor, but not quite to your take profit. Greed kicks in. It's going higher. I'll just move my take profit up a bit. Then it reverses, hitting your original take profit level, but you've moved it, so you either get out for less or worse, it reverses further and hits your break even or even your stop. Or the trade moves against you, getting close to your stop. Fear takes over. It's just a temporary dip. I'll just move my stop loss down a bit to give it more room. You know how this story ends. Lack of discipline to stick to your predefined exit strategy. These aren't hypothetical scenarios. These are the rites of passage for nearly every new trader, including myself. The common thread? A breakdown in discipline. It's not an overnight transformation. It's a habit, a muscle that needs consistent training. Define your trading plan with granular detail. This isn't just about strategy, it's about the rules of engagement. Exactly what needs to happen for you to even consider a trade? Be specific. This is where most discipline breaks down. Where exactly will you get out if you're wrong? And critically, once it's set, you don't move it closer, and you especially don't move it further away. Where will you take profits? Is it a fixed target, a trailing stop, or based on specific price action? How much capital are you risking per trade? This needs to be a fixed percentage. This is non-negotiable. When will you trade? When won't you? Avoid trading during highly volatile news events unless your strategy specifically targets them. This is crucial. If you hit a certain number of losses or a specific monetary loss for the day, you stop trading, period. Go for a walk, read a book, do anything but look at charts. This prevents revenge trading. 2. Journal everything. And I mean everything. This is your most powerful tool for self-awareness. Before the trade, why are you entering? What are your entry, stop, and take profit levels? What is your expected outcome? During the trade, note your emotions. Are you feeling greedy, fearful, impatient? After the trade, what was the actual outcome? Did you follow your plan perfectly? If not, where did you deviate? What was the emotional catalyst for the deviation? What did you learn? Example journal entry. Trade number 123. XYZ stock. Long. Plan. Entry at 100. SL at 98. TP at 104. Followed plan? No. SL moved to 97 after small dip, then moved TP to 105 due to FOMO. Actual exit at 102.
Lesson: sticking to original targets would have been better. Greed was the driver. This isn't just fluffy talk. Before entering a trade, take a deep breath. Acknowledge any emotions you're feeling. Are you feeling impulsive? Overconfident? Recognizing these states before you act can give you the precious second you need to pause and refer back to your plan. Meditation, even 5 to 10 minutes a day, can significantly improve your ability to observe your thoughts and emotions without immediately acting on them. Don't jump into live trading with your life savings. Start with a demo account, or if you must use live money, use the smallest possible position sizes. The goal here isn't profit, it's to build the habit of disciplined execution. Prove to yourself that you can follow your plan 10, 20, 50 times in a row, regardless of the outcome. Once you've demonstrated that consistent adherence, then you can slowly scale up your position size. No successful business operates on whims and impulses. They have business plans, budgets, risk assessments, and clear objectives. Your trading should be no different. This mindset shift is critical. When you view it as a business, emotional decisions become unprofessional, and adherence to your plan becomes your highest priority. Before every single trade, even if it feels like the perfect setup, take a 5-second pause. Ask yourself, does this trade meet all my predefined criteria? Am I feeling emotional right now? If the answer to the first is no, or the answer to the second is yes, then you don't trade. It's that simple and that difficult. Before you even open your trading platform each day, run through a mental or physical checklist. Have I reviewed my journal from yesterday? Am I well rested and alert? Have I checked for any major news events today? Do I have my trading plan clearly outlined? Am I emotionally balanced? If you can't tick all these boxes, seriously consider stepping away. Let me be brutally honest with you. Without discipline, you are simply gambling. The market is an unforgiving arena. It will exploit your every weakness, your greed, your fear, your impatience, your overconfidence. It doesn't care about your good intentions. It only cares about execution. And if your execution is chaotic and driven by emotion, your account will reflect that chaos. You might get lucky once or twice, but consistent profitability is a direct byproduct of consistent, disciplined application of a proven edge. Trying to trade without discipline is like trying to build a skyscraper without blueprints. It will inevitably collapse.
Visual cues. Print out your trading plan and stick it to your monitor. Have your daily maximum loss clearly visible. These constant reminders can act as a circuit breaker for impulsive actions. Accountability partner. If possible, find another serious trader and agree to hold each other accountable. Share your trading plans and journal entries. Knowing someone else is watching, in a supportive way, can be a powerful motivator. Celebrate small victories. When you do stick to your plan perfectly, even if the trade results in a loss, acknowledge that victory. You won the mental game. This positive reinforcement strengthens your discipline muscle. Detach from outcomes. This is advanced but critical. Your discipline is not measured by winning trades, but by adhering to your process. A disciplined trader can have a losing trade and still consider it a good trade if they followed their plan perfectly. Conversely, an undisciplined trader can have a winning trade, but if they broke their rules, it was a bad trade that reinforced poor habits. Learn to say no to trades that don't fit your criteria. No to moving your stops. No to revenge trading. This single word, when applied consistently, is the foundation of trading discipline.
Now, if you're finding this deep dive into the mental game valuable, if it's sparking those aha moments, then do me a huge favor. Hit that like button, not just for me, but for yourself. It's a small, disciplined act that helps me know this content is resonating, and it helps other traders like you discover our community here at Trading Psychology. And while you're at it, if you haven't already, click that subscribe button and ring the notification bell so you never miss another crucial lesson on mastering the markets. Let's illustrate this with a hypothetical situation. Example, the impatient trader versus the disciplined trader. Imagine two traders, Alice and Bob. Both have the exact same strategy for trading the S&P 500 futures. Enter long when the 5-minute chart shows a clear break above the previous hour's high, only if the volume on the breakout candle is 1.5x average and the RSI is not overbought, below 70. Stop loss, 5 points below the breakout candle's low. Take profit, 10 points above entry. Alice, the impatient trader. It's 10 a.m. Alice sees the S&P 500 futures creeping up towards the previous hour's high. Her heart starts pounding. It's so close. The volume isn't quite 1.5x average yet, and the RSI is at 72, just slightly overbought. But she feels it. This is the move. She enters long, thinking it'll probably break higher and the RSI will cool off as it pulls back slightly. The market does indeed break the high, but the volume isn't there and the RSI is extended. It pushes up for a few points, then starts to consolidate. Alice, now worried, moves her stop-loss closer to break even to protect profits. The market then has a small, sharp pullback, hitting her modified stop-loss for a tiny profit or a small loss. Immediately after, it resumes its rally, and if she had just stuck to her original stop and take profit, she would have hit her target. She kicks herself, feels frustrated, and blames the market. 10 a.m. Bob sees the same setup. The price is approaching the previous hour's high. He checks his criteria. Clear break above previous hour's high? Not yet. Volume 1.5x average on breakout? Not yet. And the current volume is just average. RSI below 70? No, it's at 72. Bob acknowledges the temptation, but his plan is his plan. He waits. 10 minutes later, a strong candle erupts, breaking the high. The volume on this candle is clearly 2x average. The RSI has pulled back slightly to 68. All criteria are met. Bob calmly places his long order, sets his stop loss 5 points below the candle's low, and his take profit 10 points above his entry. The market moves decisively in his favor, hitting his take profit exactly as planned. Bob takes his profit, records the trade in his journal, noting he followed his plan perfectly. He feels a sense of quiet satisfaction, not euphoria. The difference isn't in their intelligence or their strategy. It's purely in their application of discipline. Alice was reactive. Bob was proactive and systematic. Imagine these scenarios playing out over weeks, months, years. Alice's account will be a roller coaster, eroding slowly due to emotional decisions, revenge trading, and prematurely exiting good trades. Bob's account, on the other hand, will show steady, compounding growth. He will experience losses, of course, because no strategy is 100% accurate, but his losses will be small and controlled, a necessary cost of doing business, while his winners will fully capitalize on his edge.
Discipline is the bridge between a potentially profitable strategy and consistently profitable execution. It's the invisible hand that guides you through the market storms, keeping you anchored to your plan when everyone else is being tossed around. It is, without a shadow of a doubt, the trader's superpower. It allows you to transform knowledge into action, potential into profit, and chaos into control. Now, before we wrap up, I have one more request, and it comes from the heart of what we do here at Trading Psychology. If this video has empowered you, if it's given you a fresh perspective, or if it's simply reminded you of the fundamental truth of trading success, then please take a moment, leave a comment below. Share your biggest struggle with discipline in trading or your best tip for staying disciplined. Your insights not only help me, but they create a rich, supportive learning environment for every single person who watches this. Let's build a community of truly disciplined traders. Together, thank you for joining me today. Keep practicing, keep learning, and most importantly, keep applying that superpower. I'm T2, and I'll see you in the next video where we'll continue to unravel the mysteries of the trading mind.